Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, and welcome back to the IceCap Canadian Market Wrap with me, Richard Diaz. This week's episode 6, will be a brief overview of what we think is going on in China and how it relates to the Fed and the future of risk assets. But first, I want to thank everyone for the comments, the feedback, and the words of encouragement. Okay, so let's go. As usual, this week's video is split into a few sections. What do rate cuts have to do with China? And the 3 Ds of China's deflation. Let's get started with the Fed and what it has to do with China. Firstly, a couple weeks ago, the U.S. Federal Reserve cut its main policy rate by 0.5%. That's 50 basis points for you finance bros out there. Now, for those of you who don't know, the U.S. Federal Reserve, or the Fed for short, is the world's central bank. Now, this is because the U.S. dollar remains the global reserve currency, for which we'll definitely be putting out a video soon enough. But as I'll explain, this wasn't just some ordinary move. This chart that I'm showing you shows you how rare, in fact, it is. On the bottom, you've got the Fed's main policy rate, known as the Fed funds target rate. And on the top, in blue, you've got rate cuts. And if you remember from last video, those gray bars signify U.S. recessions. And as you can see, it basically never happens where you get a 50 basis point cut outside a either domestic crisis or certainly a foreign one that directly impacts the U.S. Fed or the U.S. economy. So what motivated the Fed? China. Outwardly and very much in practice, the U.S. and China are rivals. Politically, economically, and increasingly militarily. However, both governments and definitely their respective central banks know that there is an economic symbiosis between these two economies. Bad things in one economy will inevitably affect the other, and vice versa. And we can't presume to know what's going on in the Fed, but it's IceCap's view that they cut rates to alleviate some of the pressure on Beijing and the PBOC, the People's Bank of China, aka China's central bank. One reason is that China imports U.S. monetary policy. This is because of a concept called the impossible trinity. Now, this is a fuzzy concept. It's far from perfect, but it's a useful oversimplification. In general, basically, one economy cannot have free capital flows, independent monetary policy, and a fixed exchange rate. They have to pick 2 of those 3. This matters because for various political reasons, China insists on restricting cross-border capital flows. And there you can see them at the bottom of our triangle. However, money does sneak out. Just ask my loony hour compatriot Steve Saretsky and the good people of Vancouver. And China's peg to the US dollar is a soft one or a rolling peg. This is why I qualify this slide with the word kinda. Over the years, capital has been desperate to leave China for several reasons, like portfolio diversification, tax avoidance, and the search for better returns outside China. But now with the economy in big trouble and money going to money heaven, as debts default and asset values fall, there's increasing pressure on the soft peg and the currency, the yuan or renminbi. And of course, interest rates play a big part of that too. With the Chinese economy slowing, the PBOC has eased monetary policy and lowered interest rates in an attempt to reflate the economy. Whereas the Fed's main policy tool, the Fed funds rate, remains elevated up till a couple weeks ago. And this interest rate differential exacerbates the flow problems we talked about and adds to the pressures on facing China and its economy. And this is part of the reason why we think the Fed cut by so much. And given the recent monetary policy moves by the PBOC and the fiscal injections by the Chinese federal government, it's difficult to believe that there was not some kind of coordination with the US and the Federal Reserve. So why is China doing so poorly, and why do they need that fiscal bazooka and the liquidity injection and the nudge from the Fed? And the answer is real estate, but I love alliterations, so this section is called dwellings. Canadians are all too familiar with housing bubbles, but China's economy has been a housing subprime bubble on steroids. Since the financial crisis in 2008, the real estate market has essentially morphed into a giant Ponzi scheme, where some property developers use deposits paid by new buyers to finance construction of apartments they'd already sold. One of my favorite parts of this story is the ghost cities that popped up seemingly overnight, with few, if any, people living in them. And then there's also stories of themed cities that try to replicate those of the English and French countryside. That image on the bottom right is a town in China somewhere, although it looks exactly like a Middle English town. Anyways, prices soared, mortgage debt followed, and the speculative fervor hit that nation like no other. Because of the closed capital account and limited capital market options, entire family fortunes were plowed into these assets, and of course, valuations soared. Now, on this chart on the left, you can see what's sort of happened, and it's absolutely bananas. By 2021, China was home to some of the most expensive cities in the world. Price-to-income ratios were absolutely nuts in the 30s and 40s, as you can see from the chart, and rental yields, another valuation metric, were absolutely depressed. It made absolutely no sense. Unfortunately, all bubbles burst. China's property prices have now been falling for a record 12 months in a row. As you can see from the chart, floor sales, a proxy for real estate activity, has also collapsed. Buyers of at least 100 projects in more than 50 cities have stopped making mortgage payments due to construction delays and concerns over falling prices. And there's absolutely more pain to come. According to the Wall Street Journal, there might be as many as 90 million empty units in China. Canada, eat your heart out. Additionally, this drag from housing is leached into other parts of the economy, and that makes sense, of course. People feel poorer, less confident, and their consumption falls as a result. Again, Canadians know a thing or two about this. These growing debt deflationary pressures due to crashing property markets and falling consumer confidence have exposed China's over-reliance on exports in a weakening global trade environment. Enter the CCP and the Big Bazooka. Now, this Big Bazooka is reference to the ECB and the Euro area's response to last decade's Euro crisis, which was huge monetary and fiscal stimulus to fight deflation. And China, desperate to arrest this decline in house prices, wealth destruction, and the potential political fallout, have basically started to do the same thing. Chinese authorities have stepped in with huge stimulus package. Now, these include lowering interest rates, injecting liquidity into the banking system, lifting home price restrictions, subsidizing consumer goods replacements and business upgrades, and my favorite, direct cash handouts to families. Now, will it work? Maybe. Stock prices have certainly ripped. The chart that I'm showing you here is the Chinese equity market and the Chinese equity market relative to global stocks in US dollars. Clearly, they've ripped almost 20% in just a couple of weeks, but is it sustainable? And we don't really think so. Why? Section 3, debt. China has a lot of it. China has a lot of debt. This chart is debt to GDP ratios for selected countries. Total non-financial sector debt is nearly 300%. That's very high, by the way, and it's almost as high as Canada's. And you can see Canada on the left there, and China in red. It's also really high relative to its counterparts. And this has become super interesting for me because other middle-income countries like Brazil, Mexico, Indonesia, Thailand, etc., have a similar GDP per capita, and you can see that on the left-hand side over here, but have a much, much lower debt to GDP levels. And this is where we think a lot of these stimulus packages are fundamentally unsustainable because China has to choose between a beautiful deleveraging, which is basically not possible, and an economic malaise. They're stuck between a rock and a hard place. We end today's video with our final D, demographics. Now, demographics are really tricky because they're slow moving and they're often quite ephemeral. And my old boss at my old job, God love him, great guy, always hated when I brought it up. But I think it's really important and we have to talk about it when we talk about China. Crappy demographics is not something unique to China. Most countries outside of Africa are dealing with it, some more than others. Japan, South Korea, and certain European countries come to mind. But when we're thinking about China and we're focused on having 3 Ds for an alliteration, demographics absolutely comes up. And the issue China's having is a rising age dependency ratio. And that's what this chart shows us. There's a shrinking number of people able to work versus sort of their replacement. So either very, very young, and then, of course, there's the old people on top. And so that's what this chart shows you. This falling red line is the potential workers or potential employment. And then total population is the blue line. Now, that's already starting to fall, which, of course, is bad if you have an excess supply of real estate. you're extremely over-levered, two things which we've demonstrated. And it's especially bad if you have an aging population, meaning that relative to your workforce, so people between the ages of, let's say, 15 and 64, the number of people you have in your economy is rising. And so what that means is going forward, not only is China going to have to deal with deflation in assets, a debt burden that is significant and higher than its middle income counterparts, but also it's going to have less workers to make up for that shortfall. And that's a really sort of a structural problem that it's not at all clear that short-term fiscal or monetary stimulus can deal with. And that's fundamentally why we think that although you might have a short-term pop in financial market and capital market assets, over the longer run, China really has to deal with this on a more structural level. Now, there are some ways that we can deal with it, which is, of course, deleveraging, like Ray Dalio said, and economic malaise. And always the wild card that is very, very difficult to pin down is a major, major boost in productivity, which can deal with a lot of these issues. So that's a wrap for this week's episode. Thank you so much for listening. Thanks again for the comments and the feedback. I really, really appreciate it. It's super motivating for me. Always feel free to get in touch. Here's my email. And if you could send this to someone that you care about or love, a friend or family member, I'd really, really appreciate it as we try to grow this channel and get those subscribers up. Thanks, and see you next week.